Happy New Year, ladies and gentlemen, and welcome to 2026. Every year, the world celebrates progress. Markets open, currencies trade, systems hum. But this year, something quietly broke. Global debt hits 94.7% of GDP. 23 nations now owe more than their entire yearly output. Over 3.4 billion people live where debt interest outpaces education and health. These aren't predictions, it's already here. And most won't see it until the system crosses a line it can never return from. Welcome to the Wealth Timeline, where money, power, and history quietly shape the world around us. Because what's unfolding in 2026 didn't start with a crisis. It started 54 years ago with a decision that seemed temporary at the time. As 2026 begins, the world looks stable on the surface. Central banks across Europe have repeatedly lowered interest rates since mid-2024. The Federal Reserve cut rates 3 times in late 2024, bringing the upper target from 5.50% to 4.50%. Markets function, currencies trade, systems hold. But history shows that this is often when the most important shifts are already underway. Total global debt now exceeds $251 trillion. Public debt alone stands at $99.2 trillion. In the United States, general government debt rose to 121% of GDP. In China, debt increased to 88% of GDP from 82%. Japan carries a staggering 230% debt to GDP ratio. None of this happened by accident. It's the inevitable outcome of a system designed 50 years ago to solve a different problem. Because stability has a cost, and someone always pays it later. August 15th, 1971, Sunday evening, President Richard Nixon announced his new economic policy in a televised address. The words sounded reassuring: temporary measures to protect American workers, create jobs, stabilize prices. But buried in the announcement was a single line that would reshape global finance. The United States would suspend the convertibility of the dollar into gold. For 27 years, the Bretton Woods system had fixed foreign currencies to the US dollar, whose value was expressed in gold at $35 per ounce. The system worked until it didn't. By the 1960s, a surplus of US dollars caused by foreign aid, military spending, and foreign investment threatened the system. The United States was printing more dollars than it had gold to back them. In the first 6 months of 1971, $22 billion in assets fled the U.S. France, sent a battleship to New York City to retrieve French gold deposits. Britain requested $3 billion in gold be moved from Fort Knox. Nixon's advisors told him the system was unsustainable. The gold reserves were draining. Something had to give. On August 13th, 1971, Nixon met secretly at Camp David with Federal Reserve Chairman Arthur Burns, Treasury Secretary John Connally, and Paul Volcker. 2 days later, he closed the gold window. Nixon's speech shocked many abroad, who saw it as an act of worrisome unilateralism. But domestically, the announcement was framed as temporary, a strategic pause to reform the system. In December 1971, the Smithsonian Agreement attempted to rescue the arrangement by devaluing the dollar and widening exchange rate bands. Nixon called it the most significant monetary agreement in the history of the world. It lasted 15 months. By March 1973, the Bretton Woods system was abandoned entirely in favor of floating exchange rates. What began as a temporary fix became permanent. The world had entered a new era. Fiat currency, backed by nothing but trust and government promises. It worked, but only under conditions that would not last. At first, floating currencies seemed like liberation. Governments no longer faced gold constraints. They could expand money supplies to meet economic needs. Central banks gained flexibility to respond to crises. Through the 1980s and 1990s, the system delivered growth. Developing economies modernized, global trade expanded, financial markets deepened. But each success created a dependency. Without gold as a constraint, governments discovered they could borrow more easily. Without fixed exchange rates, debt became a tool for managing short-term problems. The assumption was simple: growth would always outpace debt. Economies would expand faster than obligations. Future tax revenues would cover present spending. This worked during boom periods, but after 2008, something changed. The extraordinary policy responses to the global financial crisis transformed central banking. Interest rates dropped to zero and stayed there. Central banks bought government bonds by the trillions. Quantitative easing became permanent vocabulary. Then came 2020. COVID-19 shutdowns triggered unprecedented borrowing. Global debt to GDP ratio surged to 98.7% in 2020. Governments spent trillions to prevent economic collapse. Central banks printed money to fund the spending. It was necessary at the time, but it locked in a structural dependency. When inflation returned in 2021-2022, central banks raised interest rates aggressively. Now governments face a compounding problem: higher debt loads, higher interest costs, slower growth to service both. The persistently high global fiscal deficit, averaging around 5% of GDP, is the main driver of rising public debt. The stronger the system became, the harder it was to stop. The warnings aren't hidden. They're in the data. High uncertainty could prompt fluctuations in interest rates, and concerns about excessive market volatility arising from sovereign refinancing risks make it a challenge for central banks to maintain both price and financial stability. Stabilizing debt to GDP at its 2024 level requires significant consolidation for most countries. Translation: to simply stop debt from growing as a share of the economy, governments would need to cut spending or raise taxes dramatically. Given current projections, debt ratios are set to rise, and in some cases, like Brazil, China, France, and the United States, significantly. In 2025, the Federal Reserve delayed rate cuts through much of the year, citing uncertainty surrounding tariff policies. Fed Chair Powell stated that inflation forecasts went up materially as a consequence of tariffs. The dilemma is becoming visible. Central banks want to lower rates to ease economic pressure, but lowering rates risks reigniting inflation. Keeping rates high increases government interest costs. Core inflation has stabilized at around 3.3% for the past 6 months in the US, while its pre-pandemic level was typically closer to 2%. This creates a dilemma for the Fed and other central banks. For decades, governments could borrow cheaply. Now borrowing costs have doubled or tripled. Legacy costs from COVID-19, such as subsidies and social benefits, combined with rising net interest costs, are keeping deficits elevated. Nothing collapsed. And that was the problem. The system kept functioning, kept demanding more borrowing, kept postponing the adjustment. There was no single moment, no crash, no panic, just a slow recognition that the arithmetic no longer worked. Increases in some large advanced economies like France and the UK were offset by declines in Japan and smaller economies, showing that even stabilization requires someone somewhere to cut back. Unsustainable fiscal trajectories can raise risks to financial stability and increase pressures to consolidate, resulting in downside risks to inflation and growth. The breaking point isn't dramatic, it's mathematical. When debt grows faster than the economy, eventually interest payments consume more and more of government budgets. More than 3.4 billion people live in countries where net interest payments on public debt exceed education or health funding. That's not a future scenario, that's 2025. For governments in that position, choice is narrow. Cut essential services to pay interest, print money and risk inflation, default and collapse market access. None are politically viable. So most governments choose the fourth option. Delay, borrow more to pay interest on existing debt. Hope growth returns, pass the problem forward. The Fed is tasked with reviewing its monetary policy framework in 2025, identifying what has worked well and what hasn't. But the tools that worked in the past, lowering interest rates, printing money, now carry different consequences. Essays on financial regulation examine Treasury market turmoil, Federal Reserve independence, and continued fallout from the COVID-19 pandemic. Experts know the system is strained, but changing it requires coordination across nations with competing interests. From this point on, the outcome was no longer optional. The consequences are already distributing unevenly. Countries with strong currencies and deep capital markets can still borrow at reasonable rates. Countries without those advantages face much higher costs. In low-income countries, recent debt dynamics reflect more limited financial development, tight liquidity conditions, and crowding out effects. When governments borrow heavily, they absorb savings that might otherwise fund private investment. Heavy public borrowing limits credit availability or raises its cost for the private sector. This creates a spiral. Less private investment means slower growth. Slower growth means less tax revenue. Less tax revenue means more borrowing. Meanwhile, wealth quietly concentrates. Those who own government bonds receive interest payments funded by taxpayers. Those who own assets benefit when central banks keep money loose. Those who depend on wages see purchasing power erode. This isn't conspiracy, it's structure. The system doesn't require villains. It just requires time and compounding mathematics. Persistent deficits may also imply higher interest rates, as they may push up risk premia and government bond yields. Power is shifting, from elected governments to central banks, from productive economies to financial centers, from present generations to future ones who will inherit the debt. No one designed it this way. But that's what systems do. They evolve according to their incentives, not their intentions. History doesn't repeat events, it repeats incentives. In 1971, Nixon faced a choice. Endure painful adjustment or suspend gold convertibility temporarily. He chose temporary. 54 years later, that temporary fix is permanent structure. Today's policymakers face similar pressures. Endure recession to reduce debt or keep borrowing and hope for growth. Most choose to keep borrowing, not because they're reckless, because the political cost of adjustment seems higher than the risk of continuing. The Ming Dynasty made silver essential. When silver flows reversed, the dynasty couldn't adapt fast enough. Modern economies have made debt essential. When debt dynamics reverse, when interest costs exceed the capacity to service them, adaptation becomes exponentially harder. The Hoover Monetary Policy series provides in-depth analysis on global monetary policy before, during, and after the surge of inflation, showing that experts are actively studying these patterns. But knowing the pattern doesn't prevent it. Systems change when they must, not when they should. And in 2026, we're watching that threshold approach, not with panic, but with the quiet recognition that what worked for half a century may not work for the next half. 2 takeaways as we begin this year. Systems fail not from single mistakes, but from the accumulation of small compromises. Nixon didn't intend to create permanent fiat currency. He intended to solve an immediate problem. But each temporary solution became permanent structure. Human behavior under pressure is predictable. When facing difficult choices, institutions delay. They choose short-term stability over long-term adjustment, until delay itself becomes the crisis. As we step into 2026, understanding how power and money really move matters more than ever. This year won't bring collapse, but it will bring decisions that compound. Choices whose consequences won't be clear for years, maybe decades. History doesn't warn us to panic. It warns us to pay attention. If you enjoyed uncovering this hidden chapter of monetary history, make sure to like this video, subscribe to the Wealth Timeline, and turn on the bell icon, because the next story might just change how you see power itself. Money doesn't just flow, it shapes everything that comes after.